Hello, everyone. Today, our team will present a comparative financial analysis of four major companies: Tesco, Sainsbury's, Marks and Spencer, and Ocado.
We will examine their financial performance using key metrics such as price earnings ratio, earnings per share, debt to equity, return on capital employed, and share price.
By the end of the presentation, you'll have a clear picture of their financial standing and what it means for their market positioning.
First, we'll give a brief introduction to our companies. My name is Petar and my company is Tesco. Tesco is a British groceries and merchandise retailer. It was founded in 1919 by Jack Cohen. Tesco is one of the world's largest retailers measured by revenue. By far, it holds the biggest market share in the UK grocery store segment. The company operates in 11 countries other than the UK.
My name is Mikhail, and the company that I chose is Sainsbury's. J. Sainsbury's plc is a British retail company with its headquarters based in London. The company is mainly known in the food retail segment as Sainsbury's, operating supermarkets and convenience stores around the UK. The company also operates in retail clothing segment under brands like Habitat and Argos, and the financial service sector as Sainsbury's Bank. In extremely competitive retail sector, Sainsbury's faces competitors like Marks and Spencer's Group, Tesco, and WM Morrison's supermarkets.
My name is Alexander and I'll be talking about the company Ocado. Ocado is an innovative British company which is also in the retail sector. The thing that separates Ocado from their competitors is that their primary focus is on online retail instead of shopping in person. However, Ocado also owns 50% of the non-online retail business Ocado.com. The other half of Ocado.com is owned by Marks and Spencer. Ocado's headquarters lie in Hatfield, England.
My name is Elena and the company that I chose is Marks and Spencer. Marks and Spencer is a leading British multinational retailer renowned for its commitment to quality, innovation and sustainability. Founded in 1884, M&S has grown to become one of the UK's most iconic and trusted brands, operating in over 60 countries worldwide. This analysis will try to identify the strengths and weaknesses of each company. These insights can guide strategic decisions, highlight investment opportunities, and shed light on operational efficiency. Let's with the price to earnings ratio. The price earnings ratio compares the market price per share to the earnings per share, which shows how well the company is performing compared to its market price. As we see in the graph, Sainsbury has the highest PE ratio of 71.6, indicating high investor confidence and overvaluation. Tesco and Marks and Spencer have moderate ratios, suggesting balanced valuation. Meanwhile, Ocado has a negative PE, signaling losses of market concerns about profitability.
Next is the earnings per share ratio, which shows a company's profitability per share, which is crucial for understanding shareholder value. In our analysis, Sainsbury's leads with an EPS of 0.3, demonstrating its strong ability to generate profit per share. This result highlights the company's operational efficiency and effective cost management, which contribute to its financial success. Sainsbury's performance in this metric reinforces its standing as a profitable, well-managed company. Tesco follows with an EPS of 0.21, which is slightly lower but still solid. This reflects Tesco's position as a stable and reliable company, maintaining consistent profitability across its operations. Its moderate EPS aligns with its focus on delivering steady returns to investors. Marks and Spencer, however, has a lower EPS of 0.11. While this is still positive, it indicates that Marks and Spencer's profitability per share lags behind its competitors. Despite its high PE ratio, Marks and Spencer's has some catching up to do in terms of delivering tangible returns for shareholders. Finally, Ocado has an EPS of minus 1.47, which confirms its struggles with profitability. A negative EPS means that Ocado is not generating profit on a per share basis, signaling that its current business model may not yet be sustainable. This reinforces the narrative from the PE ratio and highlights the risks associated with investing in Ocado. When we combine these insights, we see that Marks and Spencer excels in profitability while Tesco delivers steady performance. Sainsbury's showed potential for growth but needs to improve its earning, and Ocado faces significant challenges in generating value for shareholders.
The debt to equity ratio measures the company's financial leverage, which is calculated by dividing the long term debts by the shareholders' equity. A lower ratio is generally favorable as it suggests the company relies more on its own funds rather than external borrowing. From the chart, Sainsbury stands out with the lowest debt to equity ratio of 0.17, reflecting its extremely conservative financial structure. This shows that Sainsbury's relies minimally on debt financing, which reduces financial risk and positions it as a stable company. The conservative approach can be particularly advantageous in times of market uncertainty or rising interest rates. Tesco follows with a ratio of 0.449, which is slightly higher but still well within a healthy range. This indicates that Tesco strikes a good balance between leveraging debt for growth and maintaining financial stability. This balance allows Tesco to fund operations and expansions effectively without overexposing itself to financial risks. Marks and Spencer, with a debt to equity ratio of 1.02, demonstrates a more aggressive financial strategy. This higher reliance on debt can amplify returns in favorable conditions but also increases risks during downturns. It suggests that Marks and Spencer is more focused on growth and expansion compared to Sainsbury's and Tesco, but this comes with the added financial obligations. Finally, Ocado's debt to equity ratio of 1.39 is the highest, raising concerns about its financial leverage. A ratio above 1 means Ocado has more debt than equity, making it vulnerable to financial instability, especially if it cannot generate consistent profits. This high level of borrowing is a significant risk factor and reflects the company's aggressive investment in growth and infrastructure. Overall, Sainsbury's and Tesco show conservative and balanced financial strategies, respectively, while Marks and Spencer and Ocado rely more on debt, with Ocado standing out as particularly risky case.
Now, moving on to return on capital employed. This measures how efficiently a company uses its capital to generate profits. Now, Marks and Spencer's demonstrates the highest return on capital employed at 16%, reflecting excellent operational efficiency. After that, Tesco follows with 10.2%, while Ocado's minus 13.7% indicates losses and inefficiency. This metric positions Marks and Spencer as a leader in utilizing capital effectively. Lastly, let's look at share prices. Marks and Spencer tops with 391.7 pence, reflecting strong market perception. Tesco and Ocado follow closely, while Sainsbury's kind of trails with 260.7 pence. Now, share price movements often correlate with investor confidence and financial performance, explaining Marks and Spencer's premium valuation. So, in conclusion, Marks and Spencer stands out for its profitability and efficiency, while Tesco balances strong metrics with low leverage. Sainsbury's shows moderate performance but a low leverage, which signals stability. And Ocado faces significant challenges with negative EPS, high debt, and poor operational returns. Each company has unique strengths and challenges, and these insights can guide investment and operational strategies. Thank you for the attention. And here is the bibliography.